This is your Wall Street wake-up call. Global stocks are down as the pound falls to a fresh low against the dollar. Let's get straight to London now. That's where Michael Hewson joins us, the chief market analyst at CMC Markets. So, Michael, the pound is now at a 31-year low against the dollar. After a week of stabilization, are these Brexit worries sort of coming back into focus in your view?
I certainly think that's the case. We've not only hit a multi-year low against the US dollar, 31 years, but we've also hit multi-year lows against the yen and the euro. And I certainly think that Mr. Carney's press conference this morning, I think, has highlighted the concerns about the UK economy. UK gilt yields are back near record lows, as are US Treasury yields. And ultimately, I think there's going to be significant pushback on the back of these measures that were announced this morning by the Bank of England governor. He has tried to shore up confidence in the UK banking sector, but ultimately I think economists are pricing in the prospect of a rate hike as early as next week.
All right, and also we're seeing yields on the U.S. 10-year Treasury sinking to a new record low, around 1.37%. How low can it go in your view?
Well, given the fact that it's probably one of the highest yielding bond yields amongst the G8, I think there's potential for it to go quite a bit lower. I think a lot could depend, on tomorrow's FOMC minutes and this week's payrolls numbers. But if you actually look at where US 10-year Treasuries are, they're trading pretty much at a 50 to 60 point premium to UK gilt yields. So I would suggest there's plenty of room to go on the downside in terms of yields.
And at the same time, stocks have largely recovered their Brexit losses, yet we have the bond market rallying. I mean, how worrisome is that the bond market is much more concerned than the stock market?
Yeah, I think that is a concern, but I think you also have to look at it in the context of the yield structure. If you look at the yield structure of, say, for example, Swiss yields, they're negative all the way out to 50 years. If you actually look at Japanese bond yields, they're negative out to 15 years. So you look at stocks and you look at government bonds, and ultimately stocks yield a lot more higher than bond yields do. So FTSE 100, for example, is trading at a 4.2% dividend yield, and even the S&P is trading above 2%. And ultimately, when you're looking for yield, stocks are pretty much the best yielding asset out there.
All right, all things we'll be watching. Michael Hewson from CMC Markets in London. Michael, thanks very much for joining us.
Thank you.
I'm Scott Gamm, and you're watching The Street.